Hi, everybody. I'm JP Locatour, a Principal Insight Analyst, LNG Natural Gas from Kepler. And with me is my colleague, Troy Carney, Senior Market Analyst, LNG and Natural Gas. And we primarily focus on the Americas side of things, in particular the US. So today we're going to go over our view of the upcoming winter months and how we see the market evolving on the supply side, the demand side, LNG prices, storage, all the big points. A lot of risk going into this winter. No one's too sure how bad or how warm or cold it's going to be. So a lot's riding on next year's market dynamics based on what the winter looks like. So here's Kepler's view, and here we go. So first of all, we're going to talk about the supply side of things. And so right now, I'm just going to go over kind of the historical side of production. So in the US, we've had a pretty steady growth in natural gas production, specifically dry gas production, up until about January of last year, so January 2023. Since then, production's been kind of fluctuating. It did hit a peak of about 106 BCFD last winter, responding to seasonal heating demand, but it's been pretty flat. Dropped a little bit in the spring months, mainly because there's just too much supply. There's not enough demand to absorb it. Storage levels, as we will discuss, ended last winter very high levels compared to the 5-year average. So there wasn't a lot of movement for suppliers to be making. So a lot of suppliers went about cutting production this year, particularly people that are non-associated gas producers, like in places like the Marcellus, the Utica, and the Haynesville. And so they've cut production to try to push prices up. And we'll talk about prices a little bit later, but they've been pretty low for most of the year, not really supporting much in the way of production growth. And you can see on the right, while you've had cuts from like the Utica and the Haynesville, you've had a lot of growth in the Permian Basin. And there's been growth in the Permian Basin because that is an oil-focused play. So all of that gas produced there is associated gas. So it's basically price agnostic at this point. These producers do not really care what prices are at on the gas side of things because they're making such huge margins on the oil side. So you've seen these big cuts in production from the natural gas producers, which have been pretty well counteracted by Permian growth, but you've still seen a little bit of supply come off as a result. So that's basically what's been happening this year on the supply side. Talking about the Permian Basin again, the production has been kind of flat there the last few months, and that's mainly because of pipeline constraints. The Permian Basin is very, very bottlenecked, does not have enough offtake. If you look at the graph on the left there, Waha prices, which is one of the two main hub prices in the Permian Basin, have spent a lot of this year negative. So they've been essentially paying people to take gas off their hands because they've had too much of it. And it got pretty bad. In September, it got to almost negative $7. So they were paying $7 an MMBTU to people to take gas off their hands. However, some new capacity has been coming online starting in September. The Matterhorn Express pipeline, 2.5 billion cubic feet per day, was built between the Permian Basin and sort of the Katy-Houston corridor. That started coming online in September. It's not fully online yet. We're just starting to get some information about how much gas is actually flowing through it. But you can really see the effect it's having on Waha prices, where you can see basically when the pipeline started up, they came out of the negative territory. And while they've edged back in a couple times into the negative 50 cents sort of area, they've been able to stay above negative territory for a good portion of this month and have actually gone up quite a lot in the last few days. Really, the metering stations are still coming online for the interstate pipelines that interconnect with it. So when those are fully online, we'll have a greater idea of how much ramp up there's actually been. The first metering station came online a few days ago on the Transco system, and they were receiving about 300 million cubic feet per day of gas from the Permian Basin via the Matterhorn Express. And on the right here, we have our forecast of Permian Basin production compared to pipeline offtake capacity. You can pretty clearly see during the summer months this year when production hit that pipeline constraint level. And now with Matterhorn Express coming online, it does give them a bit of breathing room. Now that breathing room will likely only last through next year. In 2026, they will probably hit that constraint again. There are other projects looking to come online post 2026, about 7 BCFD of pipelines, but none of those have reached final investment decision yet. But there are 3 big systems that are looking to get to that point. So in the long term, the Permian will likely not remain bottlenecked for long again, as there's just so much gas coming out of that basin and a lot of markets to eat it up. So going in, looking at the non-associated gas producers, the biggest play, of course, being the Marcellus play, which is very interlinked with the Utica play directly to the west of it. So what's been going on there? Well, we discussed earlier that there's been production curtailments. And so what does that mean? Well, basically, a lot of those production curtailments are producers either throttling well output or delaying completions or delaying well completions or delaying just bringing completed wells online and putting their gas into the market. So EQT, which is the largest operator in the Marcellus, very huge company, they've curtailed about 100 BCF of gas throughout the year. That equates to about 500 MMCFD, though it isn't specifically, it isn't spread out equally across the year, but that's about how much they've taken out of the market. Coterra, another very, very large producer, not sure what their production cuts have been, but they've drastically reduced how many wells that they have, they're going to be drilling throughout this year. CapEx to spend on drilling and completion of wells was 55% lower this year. So drastic cut to spending. And from what we can tell, it's about 200 to 300 MMCFD of supply pulled out of the market. Chesapeake, a very big player in the Haynesville and the Marcellus, they've probably made the biggest cuts to production in total. They are cutting about 500 MMCFD of production as well throughout the entire year, just from the Marcellus. They're also making similar cuts from their acreage in the Haynesville. So they're taking the biggest approach to this curtailment style of attempting to get the market a little more in balance and provide some room for prices to increase. Though not everybody is doing that. Range Resources, another very big producer in the Marcellus, has actually decided to grow production this year. But the prevailing sort of move from Marcellus and Utica producers has been to either keep production flat or cut it in an effort to keep prices a little higher. It's had mixed effects. There is some evidence that it has quite a bit of effect on the storage side of things. We've seen some lighter storage builds. Well, Troy will go over that a little bit later. But it hasn't been for naught. The prices haven't quite responded just from production cuts, but maybe that will change in the coming months. So now looking at the Haynesville, the other large dry gas play in the U.S., though the Marcellus has a large wet gas component too, the Haynesville is pretty much entirely dry gas production. So it doesn't really have any sort of liquids upsides to help it in times where gas prices are lower, like the sort of Western Marcellus does. So there's much more price-sensitive production here. Their production costs are also on the higher side compared to some of the other plays in the U.S. So there's some sensitivity here that's not present in the Marcellus. And you can see that actually production curtailment started here a lot longer before the Marcellus, which is all this year. There's been a massive slowdown in drilling and completion activity in the Haynesville that started last summer, basically, in 2023. And that is really reflective on how the production has sort of panned out this year. You can see that sort of very steady decline of production from the peak of about 15 BCFD last summer down to the current levels that are floating more towards 12. And that drop off is almost identical in shape to the amount of wells and completions that have been taken out of the sort of dynamics there. And so they've been hit pretty hard by the current price conditions and just the current sort of situation where the market is quite oversupplied, especially compared to what the demand picture looks like. So the Haynesville's taken a lot of hits. It's they've definitely been the biggest declines across all of the plays. The Utica's taken some big hits too, but that's also partially due to a shift towards liquid. So there's been less dry gas produced, but still like a large amount of wet gas being produced in that play. So the Haynesville definitely been struggling this year. So where do we think production is going to go? Well, we see production increasing, not surprisingly, because the heating season is coming up. So there'll be natural heating demand that prompts production to increase most years seasonally. So we see, our production getting up there around the 104 mark this winter, but then also increasing because we do have some extra demand coming into the market next year from the power sector and also from some new LNG feed gas demand additions. So the three main projects that are coming online next year are the Plaquemines LNG and Corpus Christi Stage 3 LNG projects. Plaquemines being greenfield, so a brand new project. Corpus Christi Stage 3 being an expansion to the Corpus Christi facility. It is several mid-scale trains being added on, 7 of them to equate to about 10 million tons per year. Plaquemines is similar in style to the Calcasieu Pass facility, also owned by Venture Global, the developer of Plaquemines, and that is a bunch of small mid-scale trains, 0.626 million tons, and that's 18 of them for a total of 36 over 2 phases. And so those projects are actually going to come online over an extended period of time. They're not big chunks of demand like the startup of a conventional 5 to 7 million ton train. They are going to bring two trains online, and the next month 2 trains online, or in the case of Corpus Christi, probably like 1 a quarter. So the entire timeline to bring Plaquemines online is about 2 years. So not till the end of 2026. Corpus Christi is a little shorter. It's got fewer trains. So you don't see a full ramp up of capacity from these facilities next year. It'll very slowly be added on. Then you have some debottlenecking work at Freeport that they've been reportedly have completed, but haven't been able to exploit quite yet. And that's about 1.5 million tons per year of extra demand coming out of that project. So in total, by the end of next year, these 3 projects should add between 2 and 2.5 BCFD of demand. So a good amount of extra demand brought into the market. And then that will help bolster production because we're going to have a little bit of extra demand. And so that will scale off into about the 108 range next winter, where you have the seasonal demand compounding with the new LNG demand. And then also in Jan 2026, we'll probably see the Golden Pass facility begin to ramp up as well, though that facility has been suffering quite a bit from delays due to the bankruptcy of their EPC contractor, Zachary. They've resolved that situation, but it is unclear how bad the delays are going to be. ExxonMobil states that they believe the project will still come online by the end of 2025, though some signs are indicating that that'll probably be pushed into 2026. And then just to talk about LNG, since we're already here, what does that additional capacity look like compared to the rest of the stack in the U.S.? So you have all of the this is nameplate capacity, not demand. So this is just how much capacity is online in total. There's fluctuations all the time with the actual output from these projects due to weather, due to market dynamics and things like that. So things can fluctuate between 80 to 110% depending on what's going on. So you have that stack of nameplate capacity at the bottom of the already online projects. And then you have Plaquemines, Corpus Christi Stage 3, and Freeport Bottleneck on top of that. So it brings us to about 110 million tons of nameplate capacity by the end of next year, which will then get a little bit higher going into 2026 as the rest of Plaquemines comes online and the rest of Corpus Christi comes online. So probably push us north into the 125 almost 130 million tons per year category. And then after these projects, you'll see some more coming online in the 2027, 2028 timeframe. But that's the supply side of things with an added little flavor of LNG. And so now I'm going to pass it over to my colleague, Troy, to talk about U.S. natural gas consumption.
Sure. So I'm going to talk about U.S. natural gas domestic consumption, which consists of residential, commercial, power, and industrial demand. Here you can see the historic demand. You can see power is kind of like the largest grower historically. Over the past 10 years, it's grown substantially. You can see also that industrial demand has also grown historically. And then residential and commercial kind of have been on kind of a little bit of a downturn over the past 10 years. Looking a little closer at the more recent demand, you still see power has been growing extremely rapidly, whereas industrial demand has kind of flattened out since the pandemic and now is no longer a kind of driver of growth. And residential and commercial demand are both continuing to go down, but that's more like the more recent downtrend is more due to heating degree days and kind of being a little bit warmer during the recent summers, as opposed to underlying demand growth loss. Yeah, so looking at our consumption forecast, you can see residential, commercial, and industrial. When we forecast at a more average winter, they're all remaining flat. So there's no actual demand loss, underlying demand loss here, but there's really no growth here at all at the same time. All of the growth is coming from the power sector. You can see power growing from in 2023 around like 35 BCF, and by 2026 we have it almost at 40 BCF per day. Looking at 2024, we're probably going to end the year around like 3.7 to 3.8% growth, and then next year it's going to step up even more to 2025 and 2026 being around 4.2%. So where's this growth coming from? We're looking at the power generation mix. You can see over the past 10 years that natural gas has grown substantially in the power generation mix. And you can see that coal has declined substantially. Another place that's growing would be solar. And you can see that looking at natural gas and kind of like utility scale solar combined, their growth is about the same trajectory on the upside as coal is on the downside. They both have the same exact slope, but negative and positive. That shows that natural gas and solar utility scale solar are pretty much completely covering the whole decline in coal. Going forward, it's obviously very good to look at the additions and retirements that are going on in the industry. So you can see in 2024, solar was by far the largest additions to the grid, whereas natural gas kind of declined slightly. Not much going on there. And coal also declined, although less slightly than it has been in recent years. In 2025, we expect coal decline to kind of increase even more. This year, coal declined a little bit less as demand was higher and the new solar capacity was not online yet. And we kind of needed more like coal demand this year. But overall, that demand center is shrinking. Like you might see some spikes in coal, you might see some like when it's hot or when extra energy is needed, but overall overall coal capacity just continues to decline. You can see that as going forward. You can see solar growth is kind of it's going to decline a little bit over the next couple of years, but it's still the strongest center of growth. And natural gas, you can see, is going next year. It's going to kind of return to additions, and then the year after that, but they're not as big as they used to be. There's not that much extra natural gas capacity coming online in the next couple of years. So then where is all this growth going to come from? So when you look at power demand, you can see that on the top there's summer growth, which is kind of like peak growth, and you can see that historically peak growth was the fastest growing sector for natural gas. Fastest growing season for natural gas was in the summer when it's hot out. But if you look more recently, shoulder month is becoming shoulder month growth is becoming much more important. It's almost tripled in its growth rate over the past couple of years, in the last few years. And because of that, you can see that although not that much natural gas capacity is actually coming online in the next couple of years, there's a little bit of growth. Most of the growth is actually coming from increased utilization of current natural gas plants. And that's why you can see shoulder and winter month like demand growing more quickly. All right, so now we're going to talk about natural gas storage.
If I could, Troy, just ask a quick question about the demand side of things on the consumption side. So I know that there's a line, sort of a price line in Henry Hub and regional prices where coal sort of becomes more economical than natural gas to burn for power. Is that a concern going forward? Like, if we're expecting Henry Hub prices to get higher, which we'll touch on a little later, but if we're expecting Henry Hub prices to, break the $3 mark, maybe get higher, is there a risk that some of that natural gas demand growth that we see actually gets eaten up by coal?
Yeah, so if you look historically, obviously it's been hot winters and natural gas prices have fluctuated a lot. So when coal kind of comes into the money, you do see coal generation spiking, and it does go up, and it has definitely a decent amount of volatility around it, where it'll spike up and then come down based on economics. But overall, there's less capacity in general for coal, and every year there's just going to be less and less capacity as plants shut down. So that spike gets less and less, and it becomes less and less important.
Okay, so that's less of an issue simply because there's going to be less coal capacity in general.
Yeah. So coal capacity is going to keep declining in general, even in like after the period that we showed before, like in 2027, there's a large increase also in plants shutting down.
Oh, interesting. Okay, thank you. All right, storage.
Okay, yeah. So let's move on to natural gas storage. So storage is highly dependent on the weather. It's kind of if you look last year, we had a warm winter. Last year we started out at around 3,775 BCF. That's where we entered the winter. We had a warm winter, which ended up meaning that our ending balance on storage was around 40% higher than the 5-year average at 2,282. That caused Henry Hub prices to kind of plummet below $2. It caused producers to look at the situation and start cutting production. And because of all the kind of production cuts from producers, and we ended up kind of coming close to where we were last year at the beginning of the winter. So in our forecast, when we look forward for this winter, we're expecting a winter that's going to be about 6% colder than last winter. Just because last winter was extremely warm, and that we're kind of looking at like a historical average. So that if we do hit that winter and hit those kind of like those temperatures that we're looking at, we end up with around 1750 BCF in storage at the end of the season, which is a very normal number, like very close to the 5-year average. Much better than we were last year. After that, we kind of look at increasing LNG exports, kind of increasing power demand, and it kind of tightens up the balance for us going into 2020, like the winter for 2025, 2026. We end up with a storage balance that's significantly lower, so we are significantly tighter, below the 5-year average, and then kind of with another standard winter, we would end up very tight into 2026, which would kind of be bullish for pricing and probably also bullish for production. So moving forward, we want to look at kind of like the winter sensitivity and sensitivity of that. If we have so basically every single winter in the past like 10, 15 years has been within a 10% band of the 5-year average that we're seeing right now. So on our current forecast, we're seeing that it's right around, it would bring us right around the 5-year average of around like 1700. After that, if we have a warm winter, which would be the low HDD scenario, we would probably see about 4 BCF lower in daily demand over the winter, which would end up leading to 570 BCF higher storage balance. So it has a big influence on the actual storage balance, going from around the 5-year average to, if we have a warm winter, being around like the maximum that we've seen in the last 5 years, which would be about where we were last year, which sent prices below $2. If we have a cold winter, looking at the high HDD scenario, we would end up with below the 5-year minimum, and that would be very bullish for prices. We haven't seen that since 2022. 2022 was kind of a strange year though, with the Russian-Ukraine war and everything kind of influencing prices. It's hard to make an assumption based on that, but it would be very bullish for prices to kind of go into to kind of come out of the winter with such a low balance, because it would just need to be refilled up and it would add incremental demand to the market.
Thanks, Troy. So I did want to ask another question about the storage side of things. So when it comes to like what people are thinking about is going to happen this winter, where's the sort of generalized outlook? Like where's our forecast? Like where's Kepler's forecast of HDDs? Like where does that lie in the sort of 5-year average? Are we kind of close to it? Are we going to see, like, are we expecting a fairly mild winter, something similar to last year? Like what's the sort of picture look like there?
So we're looking at the 5-year average. We believe the 5-year average is kind of shows a good representation of where we might be this winter. Other shops might be looking at the 10-year average. The 10-year average is only about 1% difference from the 5-year average, so they're actually pretty close. So I think that if we see an average winter, like we'll be right there.
Oh, great. All right, thank you, Troy. So now we're going to talk about, we've talked about supply, we've talked about consumption, we've talked about LNG, we've talked about storage. Finally, we get to what that all culminates to, which is our pricing outlook. So we're just going to go over a little bit of history, what happened this year with Henry Hub, and what is still happening. So it's been kind of up and down. Overall, hub prices have been pretty low. But we saw seasonally higher prices above the $3 mark throughout the winter, especially going into late January and into February. It was chilly those months, though as we edged into spring, the overall effects of the mild winter being that we had very, very high storage levels and then demand fell off. Those two factors led to Henry Hub prices essentially collapsing towards the $1.50 mark, where they basically stayed all of spring. Some early cooling demand, hot days, came online in June. So we saw a little bit of an uptick in prices towards the $3 mark. But despite the fact that a lot of the summer was very hot, especially July, where we saw record natural gas fire power burn for cooling demand, the fact that the Freeport LNG facility was offline for that entire month basically cut the teeth off that demand increase on the power side. So we then saw prices decline throughout July. And then we had a fairly mild August going into a fairly mild September, which led to prices floating around the $2 mark. But in the last week or so, we've seen prices go up quite a bit. There's many factors affecting why Henry Hub prices are going up. A lot of that is technical. So it's the end of the September contract. It's not unusual for month-ahead prices to creep up as the November contract and the October contract sort of come together there, as November is, when the heating season truly really begins. So not unusual to see that kind of price increase. But in support of these higher prices, we've had 3 months of very bearish storage injections, all around 50 to 60 BCF, which are far below what we normally see, which this time last year, talk about 90 BCF being injected versus the most recent EIA estimate of 55, I believe. So very, very low storage injections, which has led to some bullishness being injected into the market. And then additionally, relatively flat supply. And now we're kind of looking at sort of an average winter. When I say a colder winter there, just colder than last year and the year before. So the current projections show like a decent increase in consumption, maybe about 6% over last year due to heating demand. So these factors have kind of come together to help push up prices a little bit. That $3 per MMBTU sort of psychological block has been holding pretty well. Henry Hub prices did break 3, though they got knocked back down shortly thereafter. It's just the beginning of the month, so we'll see what happens. But there's a lot of buying. There's signs that perhaps November's already sold. So a lot of interesting dynamics happening right now in the market. But really, where do we see it going? So we expect prices to dip back down a bit in October as sort of the market comes to realization of what's going on, and the fact that while it's going to be a little bit of a chillier winter, current forecasts show it's not going to be that chilly. So we think, as you know, October is supposed to be quite mild. That will have an effect on the front month prices. We're expecting that injections into storage will be quite a bit higher in October, as a lot of producers are now thinking about bringing production back online now that prices have recovered a little bit and seasonal demand will start to kick in November. So there's a lot of factors at play here, but we think a little bit more supply and more storage injections and a mild October will lead to the average front month in October to decreasing, though prices will then pick back up seasonally. And we think with a little bit of tighter supply and pretty robust demand going into the winter months, we'll see prices peak out at about 333 in January this year before they seasonally decline again, and then pick back up going into the summer months as demand kicks in, LNG feed gas demand from the new facilities kicks in, and we have a little bit more room in the storage side of things as well. So that's kind of where we see prices. And then going into next winter, we can potentially see the current dynamics, how they pan out, maybe seeing Henry Hub prices getting supported up closer to $4. So conclusions. Where are we going? What is the overarching point we're trying to make here with this outlook? Well, a lot of uncertainty still. We have the projections in for what we think the winter is going to look like, but there's still a lot riding on how intense it is. You saw in Troy's seasonality analysis and sensitivity analysis that there's even a 10% swing either way is massive in terms of how much gas ends up in storage. It'll have very big effects on what the prices look like and where production goes and things like that. So there's a lot of uncertainty there. But thinking just base case, we do expect natural gas production will increase over the next year and a half. Permian Basin being the biggest increases, just since it's price agnostic gas, at least at this point. But production's got to go up because demand's going to go up. So we have extra power demand and we have new LNG feed gas demand. And so we're going to need more gas supply. Power demand and LNG feed gas demand, like I just said, we're going to see some growth there, particularly from Plaquemines, Corpus Christi, and Freeport debottlenecking, which are all supposed to come online in the sort of January to February time frame. Though something to be said, both Plaquemines and Corpus Christi have said they're going to try to export first cargo by the end of this year. We do think that there's going to be a bit of a delay, especially with Plaquemines, as they seem to be not quite apace with their commissioning activities. So we put all of those sort of the January, mid to late January time frame for coming online. And then, Troy, do you want to talk on our conclusion for storage here?
So for natural gas storage, I guess the final conclusion would be that as long as we have an average winter, which is what we're expecting, we should end the winter at around average levels, right below average levels. Nothing too bearish or bullish about it. But it's good to see after last year where we were so far above the 5-year average that it kind of destroyed the market.
Yeah, very true. $1.50 Henry Hub is not good for anyone producing gas on purpose anyway. Thank you, Troy. And then just the final point where we just talked about Henry Hub, but here's the little conclusion here. So we see prices ticking up during the winter based on, heating demand requirements and pushing them up, as is often the case. And then we'll see them drop back down into the spring months before increasing a little bit, increasing throughout the summer and then into winter, bolstered by sort of slightly improved supply-demand dynamics with a little bit of demand coming online, storage sort of ending the injection season next summer in a lower place, giving some more room in the market for prices to grow and suppliers to also grow. And so we'll maybe see prices edge towards the $4 mark by the end of next year. But yes, so that is Kepler's view of what's going on in the U.S. gas market this coming winter. If anybody watching has any questions or comments for us and the rest of the Kepler team, please feel free to reach out. We would love to hear them. And let's see what happens this winter, I guess.
Yeah, thank you, JP.
Thank you, Troy.